Hi guys, hope you're all doing well. This is Econoscope, your front row seat to the global economy, where we break down global headlines and explain what they mean for Nigeria and Africa's economy in real time. Yeah, today we're looking at a concept that is commonly, or let me say, we're looking at concepts that are commonly used in global economy. And what are the concepts? We're looking at market glut and supply overhang. So, market glut versus supply overhang in the global oil market. We're going to look at historical evolution, economic implications, and the African perspective. So, the global oil has long been shaped by cycles of scarcity and abundances. Uh, Among the most frequently used expressions in energy economics are market glut and supply overhang. So, while these terms are often used interchangeably, they describe slightly different, though interconnected, market realities. Understanding the distinction is particularly important for oil dependent economies such as Nigeria and several African exporters whose fiscal stability, foreign exchange earnings, and macroeconomic resilience remain closely tied to crude oil dynamics. Understanding the concept. Why do you need to understand those concepts? What is a market glut? What is a market glut? A market glut refers to a situation where the supply of oil significantly exceeds demand, leading to falling prices, rising inventories, and weak market sentiment. In simple terms, too much oil chasing too few buyers. A glut is typically visible through sharp declines in crude prices, excess storage accumulation, unsold cargoes, reduced refinery demand, and lower profit margins for producers. The concept is closely linked to the economic principle of excess supply. What is a supply overhang? A supply overhang, on the other hand, refers to the persistent accumulation of excess oil inventories or unsold barrels that continue to weigh on prices even after immediate market conditions begin improving. An overhang therefore represents stored crude awaiting buyers, floating storage cargoes, excess inventories above historical averages, or production capacity that exceeds current consumption requirements. In essence, a glut is the broader condition of oversupply. An overhang, um, oversupply, yes. So, an overhang is the lingering consequence of that glut. So overhang is the aftermath. What happens after oil supplies are piled up or in the vessel or on water on the ocean, awaiting buyers, awaiting transit. So the International Monetary Fund (IMF) noted that large capacity overhangs in the 1980s contributed to prolonged weak prices and discouraged investment in productive capacity. The 1980 oil glut. Let's look at the historical background of oil glut. One, the 1980s oil glut. One of the most notable oil gluts occurred during the 1980s, following the oil shocks of the 1970s. Aggressive production outside OPEC, energy efficiency improvement in Western economies, and reduced oil demand growth. During this period, oil prices collapsed from over $35 per barrel in 1980 to below $10 by 1986. OPEC lost significant market control, and excess production capacity created a prolonged supply overhang. This era fundamentally reshaped global oil geopolitics. Number two, the 2014 to 1916, 2014 to 2016 shale oil glut. Another major glut emerged between 2014 and 2016 due to rapid growth in US shale production, weakening Chinese demand growth, and OPEC's initial refusal to cut output. Oil prices fell from above $100 per barrel in mid 2014 to below $30 in early 2016. For Nigeria, foreign reserves declined sharply. The naira came under severe pressure. Fiscal deficits widened and economic recession emerged in 2016. At the time, Nigeria crude reportedly struggled to attract buyers amid global oversupply and changing refinery preferences. Third, the COVID 19 demand shock 2020. The COVID 19 pandemic produced perhaps the most dramatic glut in modern history. Global lockdowns caused airline activity to collapse, industrial consumption to fall sharply, and transportation demand plunged. At one point, US WTI, West Texas Intermediate crude, the crude features are traded below zero in April 2020. Nigeria faced massive revenue losses, reduced oil production, unsold cargoes, and fiscal stress. Nigeria crude became particularly vulnerable during the demand shock, with unsold barrels moving into floating storage. Now, the statistical perspective: oil glut versus market cycles, global production and demand dynamics. Let's look at that. According to the Organization of the Petroleum Exporting Countries, OPEC, and International Monetary Fund, IMF, global oil demand averages roughly 100 million barrels per day. Even a mismatch of 1 to 2 million barrels per day can significantly affect prices due to oil's relatively inelastic short term demand. Historically, a surplus of merely 1% to 2% of global supply has triggered price collapses exceeding 30% to 50%. This reflects the sensitivity of oil markets to expectations and inventory accumulation. Inventory overhang as a market signal. Let's look at that point. Inventory levels are critical indicators of overhang conditions. Reuters recently reported that unsold Nigerian and Angolan cargoes rose sharply amid weakening demand and oversupply concerns. Brent crude prices weakened as physical markets reflected fears of abundant supply. Similarly, analysts observed that nearly 40 million barrels of West African crude remained unsold during recently oversupply conditions. Such inventory accumulation exerts downward pressure on prices as traders anticipate weaker future demand. Now, to connect all this, you need to look at the relatable examples. Let's cite a few examples. Let's look at relatable examples. Example, for instance, a tomato market analogy. Let's just take that as example one. Tomato market analogy. Imagine a farming community produces 10,000 baskets of tomatoes. but consumers only demand 6,000 baskets. This will result in price crash. Farmers struggle to sell produce. Unsold tomatoes rot in storage. That is a market glut. Now imagine thousands of unsold baskets remain in warehouses for weeks, continue to suppress prices even after production slows. That lingering stock becomes the supply overhang. The same principle applies to crude oil. Example 2, Nigerian crude cargoes. When Asian and European refiners reduce purchases, Nigerian cargoes often remain unsold longer than Middle Eastern grades as buyers shift toward cheaper alternatives. This creates floating storage accumulation, deferred cargo loadings, and pricing discounts. In industry language, the market is in glut. Nigerian barrels face an overhang. What does this mean for Nigeria? What are the implications of this for Nigeria? One, fiscal for vulnerability. Oil contributes significantly to government revenues, export earnings, and foreign exchange inflows. Therefore, oil gluts typically result in budget shortfalls, increased borrowing, currency depreciation, and reduced public spending. A prolonged glut weakens Nigeria's fiscal buffers. Number two, exchange rate pressure. Lower oil receipts reduce dollar inflows into the economy. This contributes to naira depreciation, imported inflation, and rising debt servicing costs. The relationship between oil prices and Nigeria's exchange rate remains structurally significant. 3. Investment decline. Oil companies often delay exploration projects, deep water investment, and infrastructure expansion during glut periods. This reduces employment opportunities, technology transfer, and long term production capacity. Number 4, banking sector exposure. Nigerian banks with heavy exposure to oil and gas borrowers face increased non performing loans, credit risk deterioration, and liquidity pressure during prolonged low price environments. What is the implication of this for Africa? 1. Oil exporting economies. Countries such as Angola, Algeria, Libya, and Equatorial Guinea face similar vulnerabilities. Oil glut often trigger fiscal tightening, currency instability, reduced infrastructure spending, and slower GDP growth. Number 2, oil importing African countries. Ironically, oil importing African economies may benefit from lower prices through reduced crude oil import bills. In Nigeria, for instance, Dangote still imports some crude feedstock to support the local input it receives from NLPCL and IOCs. So lower costs and improved inflation dynamics. However, secondary effects often offset gains as any African economies remain interconnected through trade and remittance flows. Structural lessons. What are the structural lessons for Nigeria and Africa? One, diversification is no longer optional. Repeated oil gluts demonstrate the dangers of excessive commodity dependence. Nigeria and Africa must accelerate industrialization, agriculture, technology development, and value added exports. Two, refining capacity matters. Exporting crude while at the same time private local refiners import crude feedstock As Dangote Nigeria still imports some crude feedstock, to support its crude requirement, for refining activities. So that's an exposure. It exposes economies to dual vulnerabilities. The emergence of local refining initiatives, such as the Dangote refinery, has helped to reduce import dependence, improve energy security, and cushion external shocks, particularly during the recent conflict between US, Israel, and Iran, the recent war. Now, number three, sovereign wealth and stabilization funds. Countries with stronger stabilization frameworks, such as Norway's oil fund model, generally manage oil volatility more effectively. African exporters may need stronger fiscal discipline, savings mechanisms, and counter-cyclical policies. The conclusion: the distinction between a market glut and supply overhang may appear technical, but it carries profound economic consequences. A glut reflects immediate oversupply conditions, while an overhang represents the persistent inventory burden left behind. For Nigeria and Africa, this is, for Nigeria and Africa, these market cycles highlight a broader structural reality. Commodity dependence creates vulnerability to forces beyond domestic control. As global energy markets evolve amid renewable transitions, US shale production growth, and changing consumption patterns, African economies must increasingly shift from resource dependence to resilience, diversification, and industrial competitiveness. The future sustainability of African economies may therefore depend not merely on how much oil they produce, but on how effectively they prepare for a world where oil market gluts become more frequent and structurally disruptive. This is where we'll end the class today. I hope you have learned one or two things, from what I've been discussing so far. For more insightful updates of this nature, for more insightful and educative, piece of this nature, follow Econoscope, subscribe, share, download, reshare, comment, and engage. You can follow Econoscope at our YouTube handle or Econoscope_1. So see you in our next video. Bye.